Thanks for joining us in the tank today, Jon.
My pleasure. Good to be here.
Jon, it's not every day that we have someone so experienced and well recognized from the investment community join us on the show. So I'm very appreciative of your willingness to chat with us. But before we get into it, it would be great if you can give our audience a brief background on yourself and how you ended up in the real estate investment world. And, given that you're so well respected in the industry for so many years, did you always want to be in the real estate industry?
So I'm an Edmonton native. My first job out of university was as a retail stockbroker, which was a great run. Did that for 5 years. And then I joined Oxford Properties in 1980. My father had started Oxford. I started as a leasing coordinator in Toronto in 1980. And then by the end of that decade, I was in leadership and became CEO in 92, and my father left the business. After that, we went through the severely trying times of the early 90s, which was a phenomenal challenge and one of my favorite times in my business career. And then went public, built the business, and sold it to OMERS in 01. I took 6 months off, went dark, and started KingSett Capital in 02. And we find ourselves here today.
So when you took over as president of Oxford Properties, so your father, Jon Love, started Oxford Properties in Edmonton, built the first medical clinic for a client with the Poole brothers, which is the founders of PCL Constructions. Exactly. When you took over as president of Oxford Properties in 1987 and eventually became CEO in 92, what advice or words of wisdom did your father give you before kind of handing over the reins or stepping into that role that you'll remember for the rest of your life?
So I've got lots of stories they're all small anecdotes that leave an imprint. But the overarching thing that he believed in that's guided my career is high standard of values, and that's respect for other, integrity, transparency, honesty, and all that stuff. And there are many circumstances where he modeled that, where he helped me model that, and it's been the single most transformative part of me building both a career and a business.
Well, you took over in some pretty tough times for the real estate market, as you mentioned. 1987, you took over as president and then CEO in 92. During your times as head of Oxford, though, with going public in 95, doing $7 billion in acquisitions over those ensuing 6 years, and then eventually the exit to OMERS in 2001 for about $4 billion, you had to obviously see a lot of ups and downs, but eventually having the company go private twice during two down markets with the 1980s and then the dot-com crash in 2001, how did those transactions impact your views on knowing when to sell versus when to hold?
Well, first of all, let me just start with the difficult times of the early 90s. When I say difficult, it was hyper difficult, which was a fantastic leadership challenge and intellectual and emotional challenge to get through that. I had a great team. We worked together well, learned a lot from people around us. And the counterparties that we had, lenders, joint venture partners, and so on, that we worked so closely with, they were kind enough to trust us and support us and do a lot of things for us because we were open, transparent, earnest, and all those things. So that really moved the needle. I'll just give you one story. So the first time we couldn't pay the interest on a mortgage was July 4th, 1992. The life insurance company on Bloor Street, I had to go up and see them and explain to the chief investment officer that we wouldn't be able to make that month's mortgage payment. Terrifying. So I went up, very hot day. We had an idea because they also owned some properties that were managed by someone else. And so our idea was if they could let us manage those buildings, we'd take half the management fees and apply it to the loan. And while that wouldn't fix the whole problem, that would be a step in the right direction. Anyway, so I sort of pitched that idea, but I'm very nervous. As I leave and I go out the door, he stops and says, "Thanks for coming by." Well, thank you actually is the one response I didn't think I'd get. So I stopped and I said, "Thank you." He said, "Jon, we have three kinds of borrowers. The first kind borrow money, pay us back, and we like them the most. Second kind borrow money and can't pay it back and are not open with us or hurt our collateral, and we go out of our way to hurt them. The third kind are people that have a problem. They come to see us. They tell us what it is. They offer some solutions. We'll work with them, and we'll work with you. And that moment defined Oxford's strategy from 1992 to 1994, which is how we navigated the chicane without going through CCAA.
That is the most unbelievable lesson for people out there who want to hide from problems, which eventually make them worse and exacerbate them, versus people who only think they're going to hit the target 100% of the time. But majority of the situations of what you described is what people should be doing, and they choose not to, either because they're scared or because they think that they can solve it on their own before it gets out of control. But going face to face and speaking with someone providing suggestions on how to fix it is obviously a great lesson for a lot of people out there. And I'm sure a lot of people are going through that, motions right now, given the climate we're in, wouldn't you say?
Well, I'd say two things. First of all, it sounds easy to do. It's terrifying. Fact is, it's terrifying because you have to go to someone and say, I can't honor our contract. But what I found is we went to one large bank, had a loan on a property, and we knew that in 9 months, when the tenant moved out, we wouldn't be able to pay interest after that. So I went to see him, went through that whole dialogue, told him what we're trying to do, and said, but it looks like we'll be in a tough spot. I just wanted to let you know and give you a progress update. So the guy looked at me and he said, John, thank you very much for coming in, first of all. He said, secondly, do you see the piles on my desk behind me? And there's all sorts of papers. He said, those people are all not paying their interest today. Why don't you come back to me in 9 months? Tell me how you're doing. And you know what? We'll sort something out with you. Boom.
Wow.
So, it is, often we don't trust other people. No one's out to hurt you at the end of the day. In a Canadian business context, my experience has been if you're open, honest, transparent, earnest, empathetic, and say, look, I mean, everybody gets the newspaper. There was no surprise that there was these problems. So I would go through them and made sure that everybody knew well in advance of what was happening and what we do about it.
Yeah, get ahead of the problem and speak about it in person and not just try to hide behind emails, which a lot of people do these days, which can be completely taken out of context.
Let me give you another brief story. So it's 1984. We're leasing an office building in Calgary. And, we need one more major lease and working on a large firm for 100,000 feet. And finally, there was a meeting on Sunday and we made a deal, shook hands, and that was that. Went to the office Monday. I'm super pumped. I read out the deal and realized I'd made a mistake. And the mistake I'd made was that we would pay the tenant inducement when they signed the lease, but we didn't even have the building built. It should have been the later of signing the lease or when the building's built. So I got a problem. So I phoned my father and say, what should I do? So he gave me a story early in his career. Moral was just tell the truth. So I phoned the customer, the tenant back, and I said, I've got a problem. Can I come see you? So I went over to see him and I said, look, I made a mistake. This is what it is. I'll stand by it because we shook hands, but I'd be grateful if we could fix the mistake. He said, I'll get back to you. And he phoned me back. He said, John, because you were prepared to honor your mistake, we'll fix it. And we made a couple tweaks in the deal, like it was okay. But it was, it's the same story that, if you make a mistake, you tell someone. And we're all big boys. We'll stand up to it. We're all big people. And the counterparty will almost always do the right thing.
Yeah. Yeah. We've had some of our investors in our funds have told us stories about how they've never gone back on a handshake acquisition they've ever made. Even after it's gone to the lawyers and gone to the accountants and they want to renegotiate terms, they've never broken a handshake deal. And it just shows that, reputations can be built over a very, very, very long time, but they can be destroyed very quickly in one transaction. And I'm assuming
in this country, the real estate business is highly connected. The fact is, all real estate people live in the shallow end of the gene pool, no getting out. So we're all highly connected. And if someone acts well, good things happen. If someone acts poorly, the inverse is true.
Right. Yeah, and a lot of the families in our fund that are real estate families as well, from many generations, have also said that they'll never forget the people that were there for their family, meaning like the banks and the lenders during the tough times in the 80s and 90s. And
Right.
they've stuck with them for the last 25, 50 years beyond that.
Right.
So in those tough times, you remember who your real friends are, which is, the saying on the way up, people remember you on the way up, but they don't remember you much on the way down too. And the bad things you do can really come back to haunt you. So maybe back to the question at hand was, given the two transactions that happened with Oxford, the privatization in the 80s and then the go public in 90s and then the privatization again in 2001, how did those different transactions impact your views on knowing when to sell versus hold?
Well, I mean, it splits into two issues. It's being able to sell.
Right.
I mean, the many businesses, many industries are made up of, great creators, great builders, and terrible sellers. And there is, or there can be, a time to sell almost everything. And in the case of Oxford, when we did that sale in 2001, I remember being interviewed and saying, "Well, how could you sell the family business?" Well, it wasn't really a family business, but it was. I'm not selling the family; it's just a business. So, my father was still my father, and my kids were still my kids. My wife is still my wife. So, I think you have to have a sense strategically. Do you have the right capabilities to compete in a go forward world? For Oxford, what Oxford really needed and got with OMERS was significantly different access to capital. Because Oxford was at a scale where it was ready for that next leg, and OMERS, to their credit, have done great things with the business. That just were handicapped by being a $1 billion, $1.5 billion market cap public company, and so that was a decision that was a strategic decision and was the right thing. As to earlier, I mean, going public in 1995 was needing an access to capital. At the time, we had a $50 million market cap, and so somewhat less. And to get access to capital, the public markets was transformative to allow us to do all those acquisitions and grow and so on and so forth. So,
Right. So it's just right, at the time and place, like there was this decision that needed to create this unlock, and whether that was going private and getting access to a larger capital pool to deploy into investments and opportunities was the right decision for the family and for the business, which obviously are separate decisions on their
yeah,
own, but together they obviously made sense as a whole.
entrepreneurs, business builders, business creators, business builders all have one handicap, which is they think tomorrow is always better than today. So therefore, there's never a good time to sell. And in fact, that can be the downfall of many people that ride a business, perhaps lose their way, whatever, and it doesn't end well.
Mhm.
So selling a business, any business, an asset, any asset, is actually an acquired skill.
Yeah, I like to call it the delusional optimist versus the pragmatic optimist, maybe, as an entrepreneur, is a different skill
Right.
set that people learn over their careers. After you took 6 months off, you reemerged and started KingSett Capital in 2002. And now the firm has over 17 billion in assets under management and obviously has established a proven track record of delivering success for growth, income, urban, mortgage, residential development, and affordable housing investment strategies. During your time at Oxford, you obviously saw and learned a lot. How did your leadership style change or your approach to building KingSett change when you started it versus your time when you were leading Oxford?
Well, the totally different businesses and business models. The one thing that was consistent was, the need to have strong relationships with capital providers. And it was those strong relationships at Oxford that then morphed into it and allowed me to start and then ultimately build KingSett. But, it's leading a business with, 3,000 employees and, blah, 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 public company and so on, and going to a startup where to get a plane ticket you have to call Air Canada, is quite an adjustment. But it was also super energizing for me because it was taking a blank piece of paper and creating a business, putting together the right stakeholders and the right leadership team to then see a business work and flourish. And it was a lot of fun, or it has been a lot of fun.
Did you ever second guess yourself after starting KingSett, thinking the grass was always greener, but then also being a CEO of a public company like Oxford also could have been pretty comforting?
Only every morning. I mean, I think, I think I wake up every day afraid, and it gets worse as the day goes on. And I think any business leader who's not fearful is going to get steamrolled, because the fact is, we need to spend our day thinking about risk and opportunity, not just opportunity. And it's always terrifying. I mean, the private equity business is a terror wheel. You worry, can I raise the money? Then you do. You worry, can I invest the money? Then you do. You worry, can I create the value? Then you do. Then you worry, can I harvest those assets? Then you do. Then you say, well, can I raise money again? Oh my God.
A
So
vicious flywheel of fear.
it is, it's a flywheel of terror. And the, any, great PE shop, and, we view ourselves as private equity real estate, has all the same issues. And it's all a reign of terror.
A lot of people struggling to break out from those kind of salaried, cushy jobs always have this fear of like, well, there's the salary and security, but there's also the equity and the ownership equation. How do you think about those balances, and how should other people who are maybe on the fence of jumping ship to start their own thing, to have the equity and ownership building, but fear of leaving the salary and the security behind?
Well, it is, everybody's personal financial circumstances are different. And clearly, starting a business is high risk because you just don't know. And to go from startup to what I'll call scale up to what I'll call sustainability are three big changes, and they happen over time. They take different things. But if often people that are in a job think starting a business is perhaps easier than it is. So, the first thing you have to do is take a hard, pragmatic look. Then you have to say, who am I going to work with? Because if there are people that are the same as you, you'll be bound to fail. Because the first thing you need is diverse leadership. And by that, I mean people with different skills. They may not be your best friend going to the bar, but they augment the skills you may or may not have. And I think you have to understand what your financial runway is. So obviously, I left Oxford. I had enough money. I was financially okay, and I could take the risk. And I was also relatively young when I started KingSett. I was 47, so I had lots of runway before you see the taillights. I wouldn't start a business today, because I'm hovering over the tail, the runway end lights. But I think starting a business is tremendously energetic and exciting. And I would, for younger people who've got an idea that they think is a competitive idea, they think they have some competitive skills, there's nothing more energetic or exciting than executing. And it's all about putting together the right team, the right stakeholders, the right advisors, the right partners in the right structure, giving that some careful thought, and then having at it.
Yeah, those are really two great points. The best advice I got when I was raising my first fund for Ripple, when I sat down with an LP, was they weren't asking me about my strategy. They weren't asking about sort of like, my background or performance to date. They were asking about my personal runway. How long could I finance this type of building personally, knowing that I probably wouldn't be seeing much of a salary for the first several years? And that was a really good, honest question for me to think about and sit down and analyze. Do I have the runway to do that? Of course, it's up to everyone's personal decision. But if you haven't had that conversation with yourself, it's important to do that. And then secondly, investing in your team early and finding a diverse leadership team was the best advice I got. And I did that as well. And I'm very happy I did that instead of trying to do everything myself as a Swiss Army knife, which I'm sure you don't want to do as well.
Right.
Speaking of, go ahead.
No. I was, when I raised my first fund, I gave the lead investors my personal balance sheet. And I said, here's what I'm worth. This is what I have. And here's how much I'd like to put in the first limited partnership. And, that transparency, which many people find disarming, is super effective, because they say, okay, well, I see what you're doing and why. That makes sense to me. And that all works.
Absolutely. I mean, at first fund for me, same thing. Rolled a bunch of my private investments in as LP commitments at cost, even though they are worth more on paper. And that showed a lot of skin in the game for a lot of LPs to trust me. And obviously, but speaking of talent, KingSett has had an incredible, group of people around them since the very beginning. How do you think about retaining talent at KingSett? And do you give your employees the rights to like co-invest and build up equity? What are your thoughts about that?
So I think you have to do three things. One is you have to walk the talk of a culture with values, open transparency. It's got to be a good working environment. Secondly, is you got to give people interesting things to do, stretch them a bit, give them decision making power, encourage them and entice them. And then of course third is you've got to make sure they're economically well taken care of. But the economics can't don't work if you don't do the first two things. We we're pretty aggressive at inviting all employees to participate at whatever level they want to invest in the funds. And so they invest at the fund level, not at an asset level, at a fund level, same as our investors. And so today, we have hundreds of millions of dollars of inmate money, employee money, invested in our funds on the same basis as our investors. And because of that, they the second Tuesday of every month when distributions go out, everybody gets the same ping on their computer that our investors do, which does, focus the mind on what is it that we're actually doing.
That's incredible. Everyone gets the same sort of bing, like the gong ringing at the same time, knowing that they're all performing well together, which is great. And I'm sure people who leave the firm might miss that sound and have some PTSD from not having it happen when they're not at the office. But, speaking of fundraising, how has your approach to fundraising evolved since your first few funds? And how do you choose the right LPs to work with, given how long you've been in the business?
Yeah, so I'd say the biggest evolution is having shifted somewhat from a total reliance on the largest pension funds to sort of having two cohorts, which is again large pension funds, large institutions, and very large high net worth families. And they're different stakeholders, different kind of relationship servicing requirements and stuff like that. As to selection, what we do is have sort of a candid discussion about what our objectives are. And I think if where we find a high degree of alignment on objectives, then that can be a successful relationship with an investor. If someone has materially different objectives on one of a number of fronts, then that you can tell that, and you can say perhaps this isn't the right vehicle for you.
Got it. So you're trying to match obviously the focus and the goal of all the different strategies with obviously the strategies of what the LPs are trying to align with. And if there's a mismatch, then maybe it's not the right LP mix. Given the size of your assets right now and the capital allocation needs, how do you weigh the opportunities to pass on when there's smaller dollar amounts that can return significant ROI, but they lack in the scale and capital allocation needs when you look at new opportunities?
We do them all.
You do them all. Okay. That's pretty easy. So you don't have to worry about that.
I got an army out here. And if you've got a $5 million deal that is, compelling in its returns and so on and so forth, we'll do that. We've done $5 billion privatization. We've done $2 billion asset portfolios. We've done $3.2 million joint ventures.
All
so,
right.
There's no cookie cutter. If you get, you can sit down on a piece of paper and say, what does the ideal deal look like? And you end up writing all that out. The only thing is there's never such a thing as that deal. So our view is we'd like to have a broad and deep gathering system, which is why we have offices in Vancouver and Montreal as well as here. And we've got, a lot of people because we'd like to see as much as we can. And if it's a good deal, makes sense, we'll have a home for it somewhere.
Well, I'll make sure to send anything that's what I thought would be too small your way next time I see something. Given all the complementary lines of business that KingSett focuses on, how does the firm approach, de-risking opportunities across all the different lines without increasing the correlation between the market swings and obviously the downside risk? Like, how do you hedge that correlation risk at the firm?
Yeah, so I mean, they're really uncorrelated strategies. I mean, obviously it's real estate, but uncorrelated strategies. For example, our opportunity fund is an event-driven strategy. You make an investment to execute a specific event. You do it, you sell it. Full stop. Our core strategy, our lifers, assets you say, I'd like to own that for life. Our urban infill fund is a different opportunity fund with a different micro niche strategy. The affordable housing fund has got a totally different, focus. The hotels have a different, focus again. On the credit business, we've got a high yield fund, a senior mortgage fund, we've got a prime residential fund, or a CMHC issuer. They all have different strategies. So while interest rates affect everybody, real estate conditions affect everybody. Those funds have quite different drivers, and the risk management in each of those is different. So in the opportunity fund is getting off the playing field as fast as you can. Over 20 years and $30 billion of investing, our average dollar outstanding has only been for 39 months.
Wow.
And that's achieved a 2.2 multiple and so on and so forth. So, but and that's a huge risk mitigant. In our income fund, it's about asset, diversification and doing all the typical diversification things, and so it goes. So there's no blanket risk mitigant. Every strategy has its own risk strategy.
No, that makes sense. I want to switch gears and speak about the markets though here, because obviously debt funds have all been in the news lately, with Romspen being the most notable one. Right now the debt markets are tighter. Lenders are less willing to lend to projects and scale back because of the valuations are more uncertain. Meanwhile, rates are in the double digits. Wouldn't this be the most opportune time to get money at the door? When you originally raised your debt funds, you were probably at a 5%, target, but now offering loans at 10% plus. So how has your capital deployment cycles changed in the current rate environment? And are you still being cautious?
Well, I mean, as a lender, this is quite a good environment. So I would tell you, our high yield fund, over now 17 years, has returned to investors as low as 11% and as high as 14%. So it's it's a spread lending business, been pretty consistent. What we've been doing, senior mortgage fund is sort of an 8 to a 10, and so on. But what we're doing now is we are capturing less of the interest rate increase by taking less risk. So as primary lenders, sort of close in, we close in behind them. So our loan to value ratios are lower today than they were a year ago and 2 years ago. And we've been able to be more conservative while still delivering, the premium risk weighted returns to LPs. So, and the actual volume right now is less because there's just less going on in the market. Mm-hmm. And typically our activity is driven by capital transactions and new construction, and both of which have slowed materially. But we're getting our good share of volume, and some others are locked up, have capital constraints, redemption issues, and so on and so forth. And our credit funds are all fine.
Right. So I guess on the flip side, from the credit moving to the equity, with the rates of where they are, treasury yields in the high single digits, are there equity deals getting done? Are equity investors willing to deploy capital given where the risk-free rates are?
Yeah, I mean, there is capital going. I mean, we just raised $360 million of LP capital for our core fund. What we're not seeing is any distress yet, and I'm not sure we'll see much distress, to be honest with you. The U.S. market is quite different, right? The U.S. will see some material stress because of the regional banking crisis and some other reasons there. We don't have those facts here, and so we don't see any crisis. So we've got a lot of liquidity in actually every fund strategy, but are being kind of cautious to deploy it because we want to see a sort of a premium return, which we're not seeing yet.
Gotcha. I want to switch gears over to the innovation side of real estate. It seems like innovation in real estate is often slow to change, as it often comes down to the cost of capital at the end of the day. Is that a feature or a bug in your opinion? And why are the incumbents so slow to adopt innovation, in your opinion?
Well, I think it's a little bit of a misnomer if you bear with me. I mean, for example, our elevators in Scotia Plaza are all AI driven, right? And so that AI technology has improved the performance of those elevators by 100%. We have Bluetooth technology, facial recognition technology. If you were to go down in the control center of the big office complexes, you'd find an amazingly sophisticated way to do peak shaving and energy management and so on and so forth. So there has been a lot of innovation there. If you think of just basic home building, there's been little innovation. And because the industry is struggling to say, well, I don't know how to. I mean, people like Mattamy have been leaders in trying to mass manufacture buildings in a warehouse and modular and some of those things. But it's not been obvious wide adoption. And it's not quite honest, quite open to us on how you can build an apartment building with any great technological breakthrough, as much as we'd love to. But things we're working on all either go around the efficiency of operating a building or our decarbonization strategy. Something that we are working hard on, and any technology PE firm I can talk to will say if someone can crack the code of really efficient solar potential for curtain walls, they'd have a global beating business. And that to me, that's one of the greatest opportunities there is. But anyway, as I come back, we're doing tons of stuff on technology. We got 4 people who do nothing but building technology, and are working because they're leading our decarbonization, so on and so forth. I mean, who knows? We got the Royal York will be officially decarbonized by November 15th, which a 90-year-old hotel, the only hotel in Canada to achieve that, is a pretty good story.
Yeah, I mean, you and KingSett have been incredible leaders when it comes to sustainability and ESG standards with your properties, including the Royal York. But, in your opinion, what are preventing other investors from doubling down on ESG and sustainability investing in their portfolios? And what could be done to address the dollars going in, obviously, besides government grants?
So I think many don't understand the business model. For me, the business model is you make these investments, you achieve a suboptimal return from just the static investment. But then you have to build in what the potential of that investment is in the future, which gives you a premium return. So it's things like carbon tax avoidance, utility, avoiding utility irregularity. And then the holy grail, of course, is going to be customer preference. Now, we're not seeing customer pricing power yet, but I think that's a question of time. So, others who are not doing, most others aren't doing, I mean, we are a little bit on our own here, but it's my view. And let me just take a specific example. So the Royal York, zero carbon, you have to know that we're going to be going after many of our large corporate customers and say, look, we've got 20% of your business. This aligns with all of your stated objectives. We'd like 30%. We'll be going after any conference that would come to the city that, is on ESG, sustainability, climate, whatever, and say, we'd love to host you. And if someone says, well, I'm not sure your rooms are $10 more expensive, well, then we'll both know who we are.
You're calling people's bluffs. I love it. That is awesome. Bring it to them and make them look like the bad guys, even though on the surface they're saying something different.
Totally. And, this is going to be super interesting. Remember, a hotel opens up vacant every day, right? So it's a super dynamic customer response system. And I think that, we are on, I think it's November 15th, we have our big public announcement and so on and so forth. The work is almost all done. It's an unbelievable amount of work, by the way. Anyway, $65 million investment. But when it's done, we'll be the only hotel in Canada that's zero carbon.
No, I love it. It's a very bottoms up and top down strategy that you're trying to employ here for bringing more awareness and also dollars into it. So good luck with all that, John. One thing you mentioned before was innovation or lack of innovation in the home building market. The government of Ontario wants to build 1.5 million homes over the next 10 years. However, many industry people think that we simply just don't have the manpower or the bandwidth to build that many, even if we get the regulatory changes. Do you think there needs to be more innovation on the ground and in the building sciences, like materials and energy, that you have been seeing obviously in the downtown buildings you own and operate. And what is stopping people from investing in those? Are you investing in those areas personally?
Well, no, I mean, I've got a number of investments in prop tech initiatives, um, which for me, hopefully, is the double bottom line. You'd always like to think you could make some money, but it's the information flow that is most interesting to me. But I think to meet the housing targets, you got to deal with the regulatory gridlock, which is NIMBYism based primarily. You've got to deal with the labor shortage, which is massive. So our immigration strategy has to focus on people that can carry a tool and give them the credentials to exercise their trade. And thirdly, like the capital is there, the industry is there, the demand's there. So I think whether we can do an extra 300,000 units a year, I mean, that's a tall order, but we have to build more housing and we have to get at it.
Yeah, I really hope we do. And I hope there is some innovation that comes down the pipe to make this more efficient for everyone.
I mean, if you want to talk about innovation, we could build mobile home communities
yes,
that are very sophisticated, and not trailer parks, but very sophisticated. And you could populate a lot of people very quickly doing that. The problem is nobody wants it near them. So, we have to make these trade-offs, because if you want rapid housing, that is an answer.
Oh, well, the other answer too is the way that developers are charged for condo development versus apartment buildings, and the amortization of the cost over the life of the asset versus paying up front upon transfer of title, right?
Well,
completion.
Thankfully the feds, and Ontario's backed it, BC's backed it, are prepared to waive, HST and GST, which is a major mover.
Huge.
The city of Toronto's got programs for, if it's affordable housing, making a significant reduction on development fees. And those two things combined with CMHC's RCFI financing make a ton of affordable projects viable. We just have to get these things through the system faster, because everything takes forever. But there's other choices on housing. I mean, a soundbite. There's 8,500 apartments in Toronto that are used exclusively for Airbnb. Now, how New York City's addressed this is they've said Airbnb has to be a 30-day minimum. In other words, residents. So they've converted it back to housing as versus being hotel competitive. We got lots of hotel space. We don't need more hotel room, but we sure as heck need more space. So number one. Number two is you might have seen this week, BC announced a rental, a program to give people a loan to make a secondary suite in their home. Again, I think a very constructive strategy. Although many of these decisions get beat up in the regulations, because when you get to page 72 in that particular regulation, they'll only give the loan to you if your household income is below $209,000. Now, not many people in Vancouver who own a home have a household income less than 209. So, that's an imperfect set of facts, but it's the right direction. And because those things can happen quickly, because we need, the building new housing takes 3 years, 4 years. If you have to get a permit, add 3 years to that, right? Because a permit is typically 3-4 years. And it takes 3 years to build the building. So these are important long-term steps. They don't solve the current crisis. So we've got to do other things. And the other things would include a discussion on Airbnb, a discussion on, mobile home communities, a discussion on secondary suites and how to accelerate that, a discussion on regional transit. If we had up-level service to Barrie, Hamilton, and Oshawa on a 15-minute cycle all day long, you'd open up an enormous amount of geography and make it commutable to Toronto.
Absolutely. Anyway. I mean, no, for sure, John, you've been so open and transparent with a lot of your thoughts and opinions on a lot of these, proposals. And I appreciate that. But one of the things that you have been very open and transparent about is how you've been leading the back to the office mandate very early on. And I'm sure it's been a difficult situation for some of the younger generation of employees versus the old employees' philosophies of working in office. How have you been able to balance this issue? And what advice would you give to younger CEOs and leaders struggling with getting employees back to the office?
Well, I'd say to people, look, to me, this is a simple story. If you think you can do your job remotely, you're competing with talent in Manila, Bombay, Cincinnati, and Saskatoon. Okay, are we good with that?
Good.
So if you think you and B, you will learn nothing. You're just a functionary. So you're basically a commodity. You're doing a task, and you're 28. You're doing a task, and if you do the task well, when you're 48, you can do the same task. And like if you want to learn, grow, and build a career, you got to be in the office. Now, our program is 4-in-1, so 4 days in the office, and Fridays are work from anywhere, and people love it. And as I look around our office, everybody's talking to each other. Why? They're collaborating, learning, and like meetings start. People talk about different things. Zoom meetings, they go on, and boom, it's agenda. And then at the designated time, boom, everybody goes off. So, and I think like where this is going is inevitable, which is that there will be 3 days or 4 days in the office when everybody's together, because at the end of the day, most of us are social animals. And the absence of learning and growing and building relationships. How many people meet a spouse related to an office encounter or a business encounter or something like that? And if you're living in your parents' basement, you might be doing that for another 20 years.
It's great advice, John. And it also goes back to when you said you're dealing with some pretty tough issues at Oxford and had to go in person to have those tough conversations. When things are all great and the company's doing well, yeah, people can work remotely and, high five each other virtually. But when things are not going well and you need to rally the troops and be in battle mode, it's a lot harder to do remotely than when it is in person, wouldn't you say?
Oh, totally. You can't create a business by talking to a screen. You sit, you get in a room because there's every moment is full of joy and terror. And to process that and have the emotional support, you have to have people together. So I like this will all evolve. I mean, we had a professional firm. The senior partner said, I can't get my young people back in the office. It was a Toronto-based firm. So I said, okay, we're going to move that business to Winnipeg because they're all in the office. And I'm not going to pay Toronto rates for work I can get done in Winnipeg because they had half the price. Guess what? Next day, the dozen kids were all in the office. Why? Because the senior partner said to him, you can stay home, but you just have to find a new customer. But then they never thought about getting a customer because we were moving our business. Anyway.
Yeah. It's great advice, John. I appreciate it. And all the advice you've been giving, publicly and obviously in this forum is really appreciative. I want to switch gears for a sec. You've got your family office, Jon and Capital. How have you and the family thought about diversification and allocating capital to other asset classes that are obviously less correlated to KingSett in the real estate areas? And what areas are you most excited about investing in these current markets, given that you say it's a lot of idea generation and, transfer of knowledge beyond just sort of capital appreciation?
Yeah. So, I mean, we built an investment profile outside and away from KingSett, although our challenge is that if we put all of that together in a bucket, it doesn't earn what KingSett does. In fact, if we put it all in a bucket and multiply it by 2, it doesn't earn what KingSett does. So, but that said, there's reasons to do that for, diversification, liquidity, and others. I think, we really like the energy trade today because I think energy is immutable. I mean, it is. There's been so much social pressure to underweight the new investment in new energy that those that have are going to find it's increasingly valuable. So I think the energy trade is super interesting. Technology is also a heavy weight for us because we have a combination of big tech and little tech, and the little tech is a bit more sketchy because it's hit and miss. That tends to be all private stuff. But I think technology is another core theme. So those would be our, real estate, tech, and energy would be our kind of core themes.
Have you ever made any passion investments like buying a hockey team or a football team? What keeps you young and sharp besides all the amazing grandchildren you have?
Well, my wife would keep me young and sharp. I think, a passion investment, let me see. I am supporting my nephew's Calabuza baseball team in suburban LA. But no, that wouldn't be for me. I think the passion investments we would typically do are investing in like the Barlow MS Center at St. Mike's, in the new Ivy building at Western. We have a number of initiatives. That's where our passion investing would be, in trying to help other people and really think through an impact that we can make, a measurable impact. So as versus being narrow and broad, where we try to be, shallow and broad, I guess it is. We try to be focused, deep, and with high expectations of an impact.
Yeah, absolutely. And the impact has been felt very far and wide across this country. So appreciative of all the support you've been giving to all those initiatives. I got to ask you before we jump into our last section, how annoyed are you with the current situation in Ottawa and the lack of urgency and speed at which things are getting done? And will you ever run for prime minister? I'm sorry, I had to ask.
So, I'm self-aware enough to know that I don't have the right instincts to be a politician. So I would never run for public office. But I do feel as a business leader, that we all have an obligation to share our thoughts and views and not to complain about things, because that's intellectually shallow in the narrow sense. But to say, here's an issue and here's some ideas, not all of which anybody will like, but at least contribute to the discussion. I think my frustration is Canada has such enormous opportunity that is being left on the street. We've got phenomenal natural resources, human resources, financial resources. We've got so many good things going for us. And I see at all political levels that all the discussion is on wedge issues and personalities and whether LGBTQ is good or bad, or, we are a liberal democracy with a financial heartbeat. Let's create prosperity for every Canadian, coast to coast.
Mm.
Okay, let's make some big ideas, but also, why don't we make a big contribution to climate change? Why don't we we've got so many excess resources, we could disintermediate the burning of coal for energy globally. Can you imagine that as a big idea? We could really make a difference if we put our mind to it, if we work together. But there's no bold visions anymore. There's no prosperity agenda. There's no hope for the future. It's all about, this guy's a bad guy and this guy is a bad guy, and we call those elections. So it's partially because social media has connected and amplified the most fringe of thought. And to some degree, we have tyranny of the minority, right? It's unfortunate because we need some bold vision. This is a phenomenal country with so much going on, that my frustration is not what is going on; it's the lost opportunity of what could be going on.
Yeah, I think we see it on the very front lines, given that we invest at the very early stages of bold, innovative companies getting built. I think what we're seeing, though, is one, the later investor community, call it the sort of growth equity investors, are just not as ambitious. And so these founders are being forced into the US market where they can find capital and partners to work with. And then eventually the acquirers of these businesses are also based out of the US market, who are more bold and aggressive in terms of the allocation of dollars they'll put. I mean, the most perfect example is the Oxy investment and acquisition of Carbon Engineering, the carbon capture company out of Squamish, BC. That is a asset that we should be holding on to forever, as the Canadian economy is so dependent on resources like that. And, we just gave it up for, $1 billion. And we should have held on to that asset, and we should be up in arms for more of that. So the only way to do that is with dollars.
I'm going to take you on a little bit, because you're talking about that you think our capital is uncompetitive, versus, and I think it's a bit of a different story. The fact is, our economy is a tenth the size of the U.S. By definition, their capital aggregation ability is totally different than ours. I wouldn't say the risk appetite is different, but the risk appetite at scale is different. What we suffer from is an excess regulatory burden that penalizes risk taking. You can't get a permit to do something. And let me just give you one example. If you look in the U.S., they come out with the IRA, the Inflation Reduction Act. You read that act and you say, okay, I understand exactly what the rules and regs are. I can invest around that, and I can make a business model around that, and it will attract, I think, an untold sum of money. You come to Canada, And on the same nature of issues, you have to make a one-on-one pitch to the government. And if you're not GM or Stellantis, not GM, if Stellantis or the battery factory, my mind's gone blank. But anyway,
Volkswagen.
That Volkswagen. Sorry, thank you. Then you don't know where you stand. And even if you do have a good idea, it could be 5 years in regulatory purgatory. In the U.S., you go to another state and you can get going. Well, we can't get out of our own way. So, and where carbon engineering's future is, it'll all be in the U.S. Everything will be in the U.S. Why? Because the IRA makes that business an unbelievable success story, and it cannot be done in Canada. Why? Because we don't have rules. All we have is regulations. We don't have any pathway for that business to execute its strategy.
Yeah, I think where I'm coming at it from, just to make sure you understand what I'm saying, is that the investors here are not willing to stomach losses as long as the U.S. investors are in the early days of company development and research and development. Companies that just don't want to be pushed into this bad revenue mix early on, and therefore they force them to sell or liquidate or just won't continue to support them. But the U.S. investors that we work with are much more comfortable letting a company build and grow when it doesn't have the necessary revenue metrics to clearly say if this is a success or not early on. But I digress. There's a lot of differences between what you do at the real estate side and what we do at the early investment side. But we'll save that for another podcast. Before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
This one.
Perfect. Next is your favorite newsletter or blog.
My favorite newsletter or blog. My favorite newsletter. I would read my favorite. I'm going to say newspaper. The Bloomberg News, I think, is the best news.
Yeah. So you're a subscriber to Bloomberg News. You listen and read to that. Yeah. Perfect. Next is your favorite tech gadget.
For sure, this thing.
Is it a BlackBerry?
No, hey, it used to be.
Used to be, exactly. Your favorite new trend? It's got to be back to office. No.
I don't think that's a new trend. That's just given. You didn't. Let me see. Just please hold. New trend. I think, I really like the social adoption of both FaceTime and Zoom with my extended family.
Absolutely. It's very nice. And I don't look at it as screen time when I get my daughter and son to look at the grandparents when they're far, far away. So I agree with that. Favorite book or most recently read book?
It was a story about a child and a kite that I read my granddaughter.
Fantastic. And last but not least, your favorite life lesson.
Favorite life lesson. There's so many. My favorite life lesson. Okay. Hold the recording for 10 seconds. I have to just think of one.
Take your time.
One final story. Which you'll edit out. You won't edit out the story, maybe. Okay. Here's my favorite life lesson. So in 1995, we'd taken Oxford public. And brought in a Hong Kong investor, a guy named Charles Chan, wonderful guy. He put in $60 million. Market cap was 100. He was 60%. That was in July. By March of that year, the stock price had gone from 5 to 250. So it had only taken me 9 months to reduce his investment in half. So I flew over to Hong Kong, and he picked me up at the airport, and we're out at having our feet massaged at someplace. And I leaned over and I said, Charles, the company's actually done a little bit better than we had forecasted, but the stock price is really disappointing. And Charles looked at me and he said, John, you worry about the company and the stock will look after itself. The next day, I was in his office. Our market cap was 50 million. I was in his office reviewing the prospect to acquire a company called Marathon Realty. It was $1 billion acquisition. And I needed him to underwrite 150 million of equity to make that happen. We spent 2 hours. He went through it and he said, I'll do it. Years later, the end of the story is the 60 million that he invested in Oxford. 5 years later, when the company was sold, he got 300 for it. And I said to him, why did you, because that was transformative for the company. why did you do that back in 1996? He said, John, he said, I bet on people and I trusted you. There you go.
Bet on people and you will do well in life. And I absolutely agree with that, Jon. Thank you so much for joining us in the tank today. It's been an absolute pleasure, and I can't wait for people to listen to this. Thanks again.
Take care.